It is 6:20 right now. You know, when it comes to investing in mutual funds, a word of warning. Yesterday's big return does not equal future earnings.
And joining us this morning is financial consultant Andy Barkate with a warning about chasing returns.
That's right.
Good morning, you two.
Good morning. So you're saying just because it makes money now, may not make money later.
That's absolutely what I'm saying. It's something that's very hard. It's easy to say, but it's hard to do.
Okay.
Or hard not to do.
Right.
Chasing returns.
Exactly. When you keep seeing big numbers and you see the profits going up.
Well, we see a lot of the hype. It works really well for marketing, doesn't it? All these big returns. It may have happened last year, the last few years. And the implication is it may continue.
Okay.
So hence, put your money there.
Okay.
The evidence shows it really doesn't work that way.
All right.
So I don't know if we ran any graphics or not. But
we do have,
we do
have one.
Okay, we'll look at some of those. But if you look at the returns, this goes back a few years ago, but over about a 4-year span, some of the top funds, and we're talking about mainly mutual funds, 1 year over the next 4 years were actually some of the worst performers, or some of the very low performers, as you see.
Here you go.
Top-rated fund over a 4-year period over the next 3 or 4 years was rated number 841.
Oh.
So the idea is just because it did well in the past, and again, it sounds good, you want to look past that hype as an investor.
Okay.
Look at what's happened yesterday. That's yesterday. That's gone. It's not going to happen again. What's going to happen in the future? Now, look at the economy. You may look at interest rates. Look at consumer spending. Look at corporate earnings. And try to make some judgments on what types of areas may do well going forward, and then make your investment decisions more based on that.
All right, so earlier we were talking about like Starbucks. I said, hey, invest in Starbucks. Price of coffee is going up. Should we invest in something that's bad and might it turn good?
Well, speaking from the hour of the day, that sounds like a very good idea, doesn't it?
Yeah.
But then again, you want to look
exactly right.
In the past, the stock has done well, but things are going on around the company and in the industry that are going to make it more difficult. Coffee prices are going up. Commodity prices have gone up. Hence, it squeezes profits for a company like Starbucks. And earnings are what's really going to drive the price of a stock. So if you can have the clairvoyance and the ability to look and see possibly what earnings may look like for an individual company going forward, and there's a lot of ways to get that research, then that's where you want to make some of your decisions on. Just because it did well, or just because you happen to like Starbucks, which a lot of us do, including me, the drink, doesn't mean it's a good place to invest your money.
Okay. All right, very good. Yeah, words of warning. Appreciate that, Andy.
Thanks, guys.
Thanks a lot.
Thank you for joining us.
It's